Hi, everybody. Thanks so much for joining me. Before we get started, please click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen where you can get a special offer from our sponsor, The Motley Fool. You can get the top 10 stocks to buy right now.
People are looking for sales for the holidays, and we are investors, so we're looking for stocks that are on sale. I'm Travis Hoyam, and joining me to discuss a few stocks that we think are on sale is Jason Hall and Matt Frankel. How are you guys doing?
Doing great. How are you?
Doing well. Let's start out with Jason here. Jason, talk to us about the stock that you think is on sale, because I think this is one that's probably not on a lot of people's radar.
Yeah, it's one that I think there's a good chance that the majority of the people that are listening to the show probably have never even heard of. But it's a company called Chart Industries, and I'm going to introduce you to it with a chart here. So you see this absolute falling off of a cliff of the stock price. The stock price was actually it was at all-time highs. A couple of weeks ago, and then the company announced a major acquisition, and I'm going to get into it and why that's kind of my thesis here. This isn't a big earnings miss or anything like that. This is just a big acquisition and the market seeing some risk. Chart Industries, their core business is equipment and services for the equipment that's involved in cryogenic gas processing and storage. So you think LNG, right? Think about the energy crisis in Europe after Russia's invasion of Ukraine. So getting cheap LNG from places like North America and getting it to end markets where there's demand. There's a massive opportunity in hydrogen where it plays. It even plays in like the cannabis market and food services where you need cryogenic gases for processing. So it's a really, really interesting business. And Jill Evanko, the CEO, has done an incredible job over the past 4 or 5 years of rationalizing the business, getting it to better cost, and generating great operating leverage, making a lot of small acquisitions, building a stronger and stronger business. Now, what happened on November 9th is the company said, we're going to buy Howden. Howden is another industrial that does manufacturing that's kind of, it's complementary to what Chart does, but mostly supports different industries. Here's the key. This acquisition is going to double Chart's size, and it's going to be funded essentially entirely from debt, about a little over $1 billion in preferred stock, which is more like bonds than stock, common stock, and then over $3 billion in bridge loan funding. It's going to move from $750 million in net debt to over $4.5 million in net debt after it happens. This is a really cyclical industry that these two businesses serve. The risk is if business slows down, if we go into like a macroeconomic weak period, at the same time this company's adding all this debt, it's going to struggle to service the debt, much less pay it down quickly, which is what management is promising. I think it's a great opportunity because this company has proven they're really good at M&A. There is risk because this is a transformative deal, not a little bolt-on, but I think it's on sale right now, and I think it's worth buying.
So manufacturing company in some interesting industries, the doubling in size because of an acquisition, but taking on a ton of debt. So maybe a little bit of a risk reward play there, but this is a company that has proven that it can operate profitably and make solid investments. So I like that one. Matt Frankel, what do you have for us?
Well, a stock that I think on sale right now is a company called Appian, and this isn't one that's too familiar to a lot of investors. Ticker symbol is APPN, and it's kind of uncharacteristic for me as the banks and real estate guy to be recommending a tech company. And generally, I only talk about tech companies when I see really deep value, and that's kind of what I see right here. Now, Appian is kind of a unique company. What they do is they have a software platform that lets other businesses and government agencies and things like that develop apps without hiring in-house tech teams. It's generally not economical for businesses to have their own in-house developers if that's not their core business. So Appian has what's called a low-code platform. They guarantee a functional, professional quality app within 6 weeks. And they have some pretty impressive customers. Enterprise, the rent-a-car company, uses to build out their ride-sharing platform. A couple universities do. Most government agencies do. I know the Army and Air Force, and they're all clients of Appian. And the stock has been beaten down lately, and for a relatively good reason. I mean, the growth is not what we would like it to be. It's still losing money. Appian is their managers are kind of unique in the tech space in that they are very long-term oriented. They are willing to take short-term pain in exchange for long-term gains. They have capital to last them for another, year and a half at the current burn rate. But one of the things that the market's really missing, they were just awarded a $2 billion judgment from one of their biggest rivals called Pegasystems for stealing trade secrets. Now, the appeals process is going to play out for some time. It was already upheld by one appeals court, but it's going to play out for some time. That's like almost Appian's whole market cap. Their entire market cap is under $3 billion, and they just got a $2 billion judgment that accumulates interest until it's paid at 6%.
Is that the market is not valuing the company's actual operations at basically anything right now?
Right, or they don't believe they're actually going to get the judgment.
Yeah, right.
But yeah, so the growth rate isn't quite what we would like it to be because of what's going on in the market. It's a massive addressable opportunity. Every business that's bigger than 10 employees these days seems to need an app for something, and Appian can really do it cheaper and more efficiently than the competition and traditional ways of app development. I love this business, and it's one that I've owned in my portfolio for a while now. It did go kind of meme stockish in 2021. It never should have been $260 a share like it was at one point. Gladly I sold a call option against it at that point.
And sometimes when those come back to earth, they come down further than they really should.
Right, and especially in a market like this, we went from like complete irrational exuberance to whatever the total opposite of that phrase is right now, and it's one that I think is going to still have a very bright future.
It's the swing from greed to fear.
Yep.
Yeah,
and
absolutely.
It swung a lot.
Speaking of fear, the stock that I think is just crazy on sale right now is Disney. And this is a stock that fell after their most recent quarterly earnings, their fiscal fourth quarter. They just changed CEOs. Bob Chapek got apparently notice on Sunday night that he was no longer going to be the CEO and he needed to pack up his stuff. And Bob Iger is riding back in on his white horse. But this is a business that I think the market is really looking at short term. And if you're a long-term investor and you're just willing to buy and hold this for the next 10, 20 years, what a great buying opportunity. Looking at the fourth quarter, or for the full year of 2022, fiscal 2022, $55 billion in revenue, $4.2 billion in net income or operating income. That's despite burning $4 billion on the direct-to-consumer business. That's the streaming business. This is where the market, I think, is kind of misunderstanding what Disney is doing. I look at streaming as a land grab business. There's not going to be, how many streaming services do we have now? Like 20? There's not going to be 20 streaming services in 10 years. There's going to be like 3. And Disney is going to be one of them. They're going to be one of the companies that we're paying $40, $50, $80 a month to get all the content that is under their umbrella. So the point right now is to get as many customers as you can, and then you start to ratchet up prices. Remember when Disney Plus launched, I think it was $5 a month. Now we're going up to $11 a month. They've added a advertising tier that'll start, I think, at $8 a month. Could potentially generate more than the premium price. We're going to just see that go up over time. Then they have what a company like Netflix doesn't have, and that's, I think of it as a waterfall. So you create a piece of content, you put it in the movie theater, then you put it on streaming, then you have it going into theme parks. The theme park business in the last year, I don't have the number in front of me, but it's an incredibly profitable business. They still have the linear TV business, $1.7 billion in the last quarter in operating income, $8.5 billion in the last year from linear TV. That may be a dying business, but it's still a cash generating machine. The market is just wants streaming to be profitable right now. And if you think about it, they just launched Disney Plus, 3 years ago? Give it a little bit of time, give it time to breathe. These costs are going to come down. Netflix is cutting costs. The amount of money that they were paying stars to be on these shows was just insane, and it's not going to last. So I think if you have a long-term time horizon, this is a great time to get into Disney. Owning a great brand like this has never been a bad idea in the market, so that's why it's my pick.
I want to make a few quick points about Disney because that was going to be mine until you picked it. So I want to go lightning round style here. Disney has unprecedented pricing power. You mentioned they're introducing an ad tier. They are adding ads to their current pricing tier without reducing the price. And
Yes.
they're adding a higher price tier if you don't want ads. And people are going to keep paying it. They have more subscribers than Netflix if you include Hulu and ESPN, their other two streaming services. And the market cap doesn't reflect that. Now, speaking of Iger, Bob Iger is all about focus and efficiency, not so much about cost cutting as Bob Chapek was, but about efficiency. He was the one who presided over the launch of Disney Plus. He left, his tenure ended in February 2020. He presided over the acquisition of Lucasfilm, which was a bargain, in my opinion. And he outperformed the stock market during his tenure. He was CEO from 2005 to early 2020 and outperformed the S&P by 200 points, 200 percentage points over his tenure. So I'm very, very bullish about Disney, even more now than I was before. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.